Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Welcome to Grain Gab, a show where we sit back and gab about what's on our minds with the grain markets and how it's affecting you, our producer, and just what to do about it. Look, the grain markets are forever moving, crazy, downright emotional. That's why we're here to sit down, look at things holistically, find a strategic yet grounded approach to handle the obstacles that the market may give us. Hi, I'm Lori Nelsen, your host, and with us today is Kristin Stien. Hi, Kristin. And we have a special guest, Jon Bahr, our crop insurance specialist. Jon, what's your official title, man?
I am a risk management advisor and commodity broker / crop insurance agent. So
say that 10 times really fast.
I know my signature on my email is about this long. So yeah, got a few titles.
Okay, so last time we talked about establishing a marketing plan, and we've been reviewing and adjusting with our clients as they finish up planting. We're looking forward to some kind of seasonal run to get some more of this crop priced. Today, we're going to talk about just executing the plan. So we've got an offense plan put together. Now, how do we handle a defense with options and crop insurance? So if we look at something seasonal, 6 out of the last 20 years, we tend to have some kind of market high that we put in the month of June.
I sure hope that's the case today, Lori. I mean, we need something to happen because May surely didn't do it.
And today wasn't a good feel either. I mean, it's been really nice or a positive look to see December closing over 450, November closing over 1050, but we did not have that kind of price action today.
Wah, wah, wah. I mean, the reason we're talking about all of this right now is because it's go time, right? Take a look at this chart. Even 6 out of the last 20, it's been in 1 month. What is that? 6 plus 6 is 12 plus another 3, 15 out of the last 20 years. The new crop high has been made in April through August. It's go time, boys. Right? It's time to get that plan figured out and get going. And we always say a marketing plan without an execution plan is not really a plan. So we better get into this and better get hopping on it, right?
Right. Get your ducks in a row, man.
So, Lori, I mean, based off of these WASD reports that we had come out earlier this month, are we actually going to get highs?
Boy, you take a look at that. You look at that ending stock number of 1.41. You think we ought to be having some pricing opportunities closer to $5 in the nearby market with stocks to use under 10% on corn. The market's just not feeling it. So are we having some overlying news that might be keeping us from doing that, whether that's tariff-based trade talk and just a lot of unknowns? Oh, you throw in weather there. You look at weather across the United States. Lots of folks could probably use a shot of moisture, but then there's several folks that seem to be having too much moisture. Do I say too much? Too much?
You never want to curse the rain, but it's getting there for some of these folks. But I mean, at the end of the day, like, gosh, we want to say weather, but you might want to speak a little louder so the Chicago traders can hear you, because we need something to hit this market pretty hard right now. You would think, to your point, with a 1.4 billion bushel carryout on old crop, only a 1.8 projected for new crop, and that's using a 181 national average for yield. Really? Like, we're not going to see any sort of price action off of this? Jon, I mean, you're usually the bull coming out. Like, give us something here.
I'm not usually the bull, but I do agree. The numbers fundamentally are showing we should probably be priced a little higher than where we're at right now.
And to that point, right, maybe that's what's given us some level of support right now, while the fact remains that, yes, there's a few weather issues going on here and there, but as of right now, it's all, pretty kosher, pretty good right now, right?
You could just say we've traded it in a range since February on new crop, so it feels like just kind of a broken record, and I'm looking for some new news.
Fair enough. Well, and speaking of, not quite the broken record. Some things changed for new crop beans.
That 8% stocks to use. Look at that 6.7% stocks to use in the new crop. That indicates just a little bit tighter type numbers that we should probably be popping this story on that, what I like to say, a 3-week run. I'm looking for it as we come into June. I want
come on,
that
roll those dice.
Yes. Mm-hmm.
Yeah, absolutely. And I mean, there's always the balance to that, right? On beans, we may be shorter domestically, but we've got plenty of beans worldwide, right? We're still sitting on a mountain of them. On the other side of that, the corn picture is a little bit tighter worldwide but we're growing our stocks domestically. So I don't know. It's just this back and forth. I'm like, just a pop. Give me that 3-week pop like you're talking about, right? All that to say, as we look at that December market, this is where we go back to that plan, right? This is what actually matters when it's all said and done. Where are your targets at? Where are we going to be sellers at? Right? And they shouldn't just be, if the market gets here, then I think I'm gonna potentially sell. No, have those offers in place. Make sure you're ready to go, because I mean, June comes with a lot of different stuff, whether it's spraying, making hay, county fairs, vacations. People get busy during this time of the year, right? And emotions also go crazy, right? If we want to talk about weather, let's talk about emotions with weather that's added on top of that. And so you better be ready to actually pull the trigger on this. That's the offense side of things.
But with that, Kristin, I would just add your bushels attached to that target. And then what does that do for your percentage sold as we come into the season? And that might be just, maybe you've got an offer sitting there and you're like, that offer's I've got one working, it's good. No, take a look at your bushels and really talk and consider your percentage sold.
Yeah, because if you're selling 2% at those levels and you're only 12% sold, that's not enough. Not good enough, right? Like, no. Let's keep going. Let's keep getting aggressively sold. Because, I mean, as Eminem says, you only get one shot. You better not miss your chance to blow this opportunity. This white girl can't rap, but that's all I got for you. Take advantage of the shot that you get and be aggressive with that. And then there's the other piece, right? What happens if the market doesn't get there to those targets? Right? Mm-hmm. We have to play offense and defense. And what does that defense look like? Well, it looks like some optionality added to it. And so we're going to go through the basics of defense, right? Crop insurance. That's why we brought Jon on. First, we're going to talk about puts in case those targets don't fill. You want to have that downside protected as that we come into the seasonal market where we typically see that fall off post-summer, right? And so we want to keep things simple here. We want to describe what a put is and how it actually works for the farmer. So the legal definition of a put is what, Lori?
The right, but not the obligation to sell futures.
So what does that mean? If I buy a 440 put as my strike price, I have bought the right to sell corn at 440, but I don't have to if I don't want to, right? So the scenarios that actually works out is, all right, let's say we buy the 440, the ability to sell 440 corn. And what's our downside risk, Jon? How low are we going to go?
Stars align. I think 380. I don't think 380 is out of the question.
All right. Fair enough. Let's say we spend 20 cents on this put and the market at the end of November is at 380, like Jon says it's going to be. If we're in a 380 market, would you sell 440 corn in a 380 market?
Yahoo!
All day, every day, right?
Mm-hmm.
So the way that looks practically is we're selling 380 to the buyer, whatever local buyer you have, right? 380 futures. Our put is worth 60 cents. Okay. And then we spent 20 cents on it. We're netting 420 corn in a 380 market. Not too shabby, right? What about the scenario that the market goes high and stays high?
Oh, I'd let that put expire worthless all day long, Kristin.
What that looks like in real life is the market goes to 550, let's say. Would you exercise your right to sell 440 corn in a 550 market?
No.
No, you let it expire, to your point, right? You're out the 20 cents because this is on unsold bushels and you're netting 530, right? great feeling. I'd rather have 530 corn come the fall, especially right now as I'm nervous on pins and needles, wondering if we're actually going to get a rally going into the June, July timeframe, right? Is it actually going to happen? Well, at least I've got that floor in. I'm protecting profitability, or I'm protecting a lot of my costs from there. Have that floor in and then wait for this market to go higher. If not, we've got that downside covered, right? There's peace in that.
I will say, Kristin, to give you some peace of mind right now, I had heard it from a client the other day. Every year, he couldn't remember how long back, we have matched or gone through our spring pricing period every year, sometime past February. So I went kind of fact checked it. I went back to 2000. So 24 years, it did check out. We have either matched or went through our spring insurance price every year on corn and soybeans back to 2000.
So you're saying there's a chance?
There's a chance. I don't know what news is going to get us there, but there is a chance.
All right. I'm holding you to that, Jon.
All right.
And it's all recorded and posted on YouTube, so I can come back at you if it doesn't happen.
Which is 470 and 1054.
475 sounds like a real good target to me.
We did it with the beans already. We saw 1060 was it right after the trade deal, the 90-day pause. So
fair enough. And maybe weather's the thing that brings us there, right? There's still places that are plenty dry on this thing. The pushback that we always get, especially if we're saying, hey, go and be aggressively sold at 475, 495, whatever that may be, is what happens if I don't grow the crop? Then all of a sudden, those don't look like very good sales.
As you guys have said earlier, we're getting to a very crucial time, and I think that period to get corn sold and feel comfortable heading into fall is starting to shrink here a little bit. So if we do get this pop, and we want you to be able to be comfortable making those sales and not second guessing yourself. And I think a big part of that is understanding, one, how crop insurance works, and two, specifically your policy and how it relates to your operation. So I just have a very, basic example here. I used a flat number of a 200 bushel APH and 80% RP, probably the most common coverage level. So that's what I stuck with. So with our 470 spring price at the 200 APH, we have a spring insurance guarantee of $752 to the acre. The big question, what if I don't grow it and I sell up to my guarantee? What happens to me? And everybody's afraid of that buyout scenario, cutting that check back to the elevator. One thing to keep in mind is if that harvest price does go higher and you did not elect the harvest price exclusion, if you took the basic RP policy, you get that higher price in the fall. And what it does is it redoes your guarantee. So if corn goes to $7, the October fall price goes to $7 times the 200 bushel APH times 80%. We now have a new guarantee of $1,120 instead of that $752 that we originally had in the spring. So then if we only grow 125 bushels, let's say, you get to take the bushels you're short. So 125 bushels times $7 corn gives you a harvest revenue of $875. So you would have an RP check of $245 in that scenario. Knowing that that gets redone, as long as you have the RP policy, it gives you the higher guarantee in the fall if that would happen. Just to kind of walk through what that buyout would look like, and it would be a little different, but for the most part, if we sold up to our guarantee, let's say we layered in here through February, we get another bump, we end up selling 160 bushels to the acre. If we only grow 125, we sold 160, so therefore we're 35 bushels short. Typically, how the buyout works is we have an average futures price of 460. We get out of those futures for simplicity at the fall harvest average of $7. We owe basically $2.40 a bushel. Every elevator typically has some sort of buyout fee. I just use 10 cents. That seems to be a pretty common one. We would owe a total of $2.50 per bushel on the 35 bushels to the acre. So we have a buyout of $87.50 per acre. That is typically how that buyout process works, difference between where you're sold and where the futures go when you get out. So if we bring that down, we produced 125 bushels still. We still have that grain to sell at 460 is $575 an acre. We have that RP insurance check of $245. We have to take off the $87.50 for the buyout, which gets us to $732.50 per acre. So this is where I like to introduce the idea and the importance of using options. If we play the odds, history tells us the harvest price usually is lower than our spring price. So over the course of those 7-8 months, we usually trend down. But to have that upside protected and make sales when we're at profitable lines and covering that with a call option to help offset that buyout and add to your price of that 125 bushels, maybe that you still produced, and help add back to that price as we go along.
I can't highlight that spot enough, because if we go through your total revenue and we don't have that call option on, how many producers do you know that have an actual expense that's under, for corn acres, that's underneath $732 an acre?
None that I can think of off the top of my head. Not very many.
Right. And so that's always the fear, right? Is what happens if I sell, I don't grow the bushels. Now all these crop insurance dollars are going to buying out this contract rather than this. And that's where we go into the conversation of what sales are unprofitable at an insurance guarantee level, to where do we need those call options to help get back to those profitable levels? Because we, by and large, a majority of guys, as we start nearing that 460 to 490 area, are profitable in a normal year. In a normal year where they get plenty of bushels. At 160 bushels, maybe not so much. And that's where you want to be doing the math to bring that in so that we can start getting back to profitable levels all over again. It's a case-by-case scenario, but I can't highlight that piece enough when it comes to the emotion of it all.
And we hear that a lot. Well, I can't get that heavily sold. I'm losing money. But at the end of the day, we got to remember we have to take what the market gives us. They don't look and say, okay, the average farmer needs to make $850 an acre. We got to keep the market at X. I wish it was that way, but it's not. And so, I always like to show people 2014, we set a high in May of about 515, mid-May, early May. And by mid-October, we were down to 318. So we lost $2 a bushel. And people say, well, we had to pay for that buyout that 1 year that we had a yield issue out of, 20 of $87.50. But if you look at it from a marketing standpoint, if we pass up $4.80, $5, $5.20 corn, if we get the opportunity and this thing crashes like it did in 2014 on 100 bushels to the acre, half your crop, $2 loss, that's $200 an acre, which a lot of guys say, wow, that sucked. But they don't realize as big of a deal because they didn't have to write a physical check for it, when they could have sold the grain, protected their upside with a call option. If they do have to pay for the buyout, I'd rather pay $87 an acre than lose $200 in marketing, in my opinion.
Especially when you go back to the probabilities of it. If we go back to that beginning chart that we highlighted of when the highs typically happen, there's 3 months out of the last 20, right? So 17 times out of the last 20, it said forward market. The same could be said about crop insurance levels too, right? How many of the last 20 years has the spring price been higher than that fall price? And how does that play into your ending revenue to counterbalance that, right? And the calls and the crop insurance with that harvest price included are there to help give the ease into crazy weather markets. Right? When you should be selling and it's really nerve-wracking to do so, that's where the defense side of calls and crop insurance help aid in that conversation to make sure that you're playing the odds towards your favor, not against them. Jon, thank you for explaining all of that, because that makes it clears the muddy water, especially during a season like this.
In a time where emotions aren't running a buzz, because I'm just looking at the date on the calendar and I'm wondering, where are we 30 days from now? And having that plan, get your puts in place as we have a run, keep pricing, okay, and then just keep open-minded about, okay, how do I structure this and get some calls on for what if, do I dare say it, the D word actually comes in.
On that note, let's make sure we're at it. We're coming into crunch time on this. Have yourself set up for the emotional times. Make sure you're ready and you know thyself so that you can actually take advantage of this. Paige is kind of giving us the, come on, guys, I'm bored with this conversation. So we'll make sure that we keep things pushing along. Jon, Lori requested that I give cards to you and not her. So it's on you, but you only get one. All right. Okay. What's a movie or TV show you're ashamed to admit that you watch?
13 going on 30. I didn't even have to think about it. I honestly like it. I'm not going to lie. 13 going on 30. I said it.
I think I was like 15 when I watched that, and I probably haven't seen it since. So I'm going to have to like...
The Blue Razzles are the best. That's all I got to say.
Okay, on that note, join us next time. I think we're going to talk about basis and carry. Paige, thank you so much for everything you do for this team, and thanks for everyone for joining us on Grain Gab. If you like what you hear, please hit the subscribe button. It really helps our algorithms. Thanks to the Insight team for making us look good. Until next time, keep your head up, your feet grounded. Cheers.
Cheers.